Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets while also drowning out the agenda of the news media in America. So let's talk about the four things we learned this week. First, €1 equaled $1 for the first time since 2002. The euro is down roughly 15% over the last 12 months. And the last time we saw this type of percentage drop, it was the year 2015. In addition, the yen reached its weakest level since 1998 this week and has declined by about 20% over this last year. Now, all this means that our current environment, dollar strength, is a sign of investors' worry about a global recession, not just in the US, but globally. Until the dollar starts to weaken, it is difficult to believe that we've reached the lows for US equities in 2022. This also means, good news, if you've been planning a European vacation, now is the time to take that for sure. The second thing we've learned in the markets, 3-year expected inflation has been trending lower for almost a year. The current reading, 3.6%, is still well above the Fed's 2% target, but it seems that Chair Powell's message is slowly getting through despite being fogged by the current inflationary pressures. In addition, Wednesday's CPI report showed that the speed of inflation is much faster now than it was in the 60s and 70s. Back then, it took 91 months to move from 2% inflation up to 9%, versus now it only took 30 months, half the time. The third thing we learned, the last beige book by the Fed came out and revealed more signs pointing to that a U.S. slowdown and increasing concern about a possible recession. Something that stood out in this report is that inflation was mentioned 3 times more than January's report, and Chair Powell made it clear that this is his main objective, bringing down inflation, even if it results in economic pain. The fourth thing we learned this week, labor shortages have led to more job openings than unemployed workers. Despite a weak demand for workers, nearly all districts noted modest improvement in labor availability, particularly among factories and construction jobs. And we're giving you an extra one this week. The fifth thing we learned, due to inflation, all districts reported a substantial price increase in order to offset inflation. Price increases for energy, food, commodities remain significant, but there were several reports that noted that price inflation in these categories has started to slow down. That's good news. Pricing power was steady within the hospitality and travel industries as they were able to make sizable price increases with little to no pushback. And most reports believe that we should expect steady pricing pressures throughout the industry. Now, of course, if you have any questions about this week's What We Learned in the Markets, you can reach out to your advisor. Also go to our website to read an article we just wrote about tax loss harvesting. It's one of the things that can make a bad stock market a little bit better by creating some tax benefits for you. So any questions, reach out, go to our link in the website. We appreciate your continued trust in our firm.